3 days ago, my friend Sarah tried to take money out of her business account. Nothing unusual. Just £30,000 she needed for payroll. The bank told her she'd have to wait 72 hours. No reason, no heads up, just wait. That same afternoon, I met someone in risk management at one of the UK's biggest banks. Off the record, he said something that sent a chill down my spine. We're all staring at the same numbers, all worried, but no one wants to say it out loud. Here's what he meant, and more importantly, what you need to do before the rest of the world catches on. Because something is happening in UK banking right now that almost nobody is talking about. Something that could hit your money, your mortgage, and maybe your entire financial future. And the banks are quietly hoping you won't notice until it's too late. So here's the reality. And let me be clear, this isn't conspiracy talk or clickbait. This is what banks are actually saying when they think no one is paying attention. I spent last week diving into quarterly reports from every major UK bank. Not the headlines, not the press releases about record profits, but the footnotes, the dense, buried disclosures on page 73 that only regulators and accountants usually read. And what I found should have been on every front page. One huge bank, can't name them, but they're massive, revealed that 12% of their commercial property loans are showing stress. 12%. That's not rounding. That's over £10 billion of loans that might never get repaid. Another bank quietly noted they've increased their provisions, the money set aside for bad loans, by 40% in a single quarter. 40%. Think about that. They're signaling in plain accounting language. Massive defaults are coming. They're preparing. They're putting aside billions because they know what's about to hit. But here's the part that kept me up at night. This isn't just about banks losing money. I'll explain why in a minute. But first, you need to see the 3 warning signs showing this is worsening, not improving. Warning 1. The commercial property disaster. You remember how everyone started working from home during COVID? Well, most companies aren't fully returning. Office buildings across the UK are half empty, sometimes 30, 40, even 50%. In regional cities, some are almost deserted. Banks lent hundreds of billions against these buildings when prices were at their peak. Building worth £70 million, bank lends £50 million. 70% loan to value. Seemed safe. Seemed solid. Except now that same building is worth £40 million. Maybe even £35. The loan is bigger than the building. The bank is underwater. And here's the scary part. Thousands of these loans need refinancing in the next 2 years. When that happens, borrowers need new loans. But no bank will lend £70 million on a building worth £40 million. Defaults follow. Banks repossess. Sell at massive losses. And this isn't just a handful of properties. It's a tidal wave. Warning 2. The mortgage payment shock. Right now, 4 million households are remortgaging, or will in the next 18 months. They're moving from 1 to 2% interest to 5 to 6%. Someone with a £250,000 mortgage paying £1,000 a month at 2% suddenly faces £1,450 at 5%. That's £5,000 more per year. Can everyone handle that? No. Some absolutely cannot, and we're already seeing it. Missed mortgage payments are climbing. Still low compared to history, but rising fast. Add to that falling house prices, 10 to 15% in most areas, more in some, and you've got people with small deposits now in negative equity. They owe more than their homes are worth. Negative equity plus unaffordable payments equals a disaster waiting to happen. They can't sell to escape. Default is their only option. Warning 3. The liquidity signals. This is technical, but it matters. Banks need liquid assets, cash, or things they can quickly turn into cash, to cover withdrawals and payments. When liquidity ratios drop, it means they're struggling to meet obligations. Several UK banks have seen these ratios decline over the last 6 months. They're still above regulatory minimums, but the trend is worrying. Very worrying. Because bank failures don't happen gradually. One day everything seems fine. The next day, they can't pay obligations. Confidence evaporates. Deposits vanish. The bank collapses. We're not there yet. But we're closer than most people realize. Now you might be thinking, okay, banks have problems. So what? I'm not a banker. How does this affect me? Let me show you. Because it's not just about whether your bank survives. It's about what happens to everything else. The credit freeze. Nobody is talking about this. When banks start losing money on commercial property and mortgages, they don't just shrug and move on. They panic. Lending slows to a crawl. Need a loan for your small business to buy inventory? Tough luck. Want to remortgage because your fixed rate is ending? Good luck getting approval. Thinking about financing a car? Forget it. Consumer credit is drying up. This is already happening. Banks are quietly tightening standards across the board, not announcing it, just hoping no one notices. And when credit freezes, businesses fail. Not because they're badly run, but because they can't get the financing they need to bridge cash flow gaps. Profitable businesses fail. Job losses follow. More people can't pay their mortgages. Defaults rise. Banks tighten lending even more. It's a spiral, a doom loop, and once it starts, it's incredibly hard to stop. Then there's the capital illusion. People always say, banks are well capitalized. 13, 14, 15% capital ratios. They can absorb losses. Here's the problem. Those ratios are based on risk-weighted assets, not actual assets. Risk-weighted means they assume certain default rates and losses. A bank might have £300 in loans, but risk-weighted, that counts as £100. So a 15% capital ratio really means £15 of capital for every £100 of risk-weighted assets, even though they have £300 of real loans. What if those risk weights are wrong? What if actual defaults are worse than the models predicted? Capital evaporates fast. A bank that looked safe suddenly looks stressed, maybe even insolvent. That's exactly what happened in 2008. Banks seemed fine, until losses exceeded predictions. Then everything collapsed in weeks. Here's the scenario that keeps me awake. Imagine a large property company defaults on billions in loans. Multiple banks take a hit at once. Markets panic. Everyone starts asking, who's next? Which banks are exposed? Credit spreads spike. Banks can't access funding markets at normal rates. Liquidity stress starts to build. Depositors get nervous. Large business accounts, not covered by deposit protection, begin moving money just to be safe. The bank has to sell assets to meet withdrawals. But selling in distressed markets means selling at a loss. Losses deplete capital. Depositors panic more. Withdrawals accelerate. Other banks see this and stop lending to each other. Interbank markets freeze. Credit across the economy tightens sharply. Then one morning, you wake up to headlines. A major UK bank is taken into temporary public ownership. The government promises all deposits are safe, but credit cards don't work. Business payments are frozen. ATMs have limits. Sound familiar? It should. We've seen it before in 2008. But this time, government debt is higher, interest rates are higher, and the ability to bail out banks is more limited. I'm not saying this will happen, but it could. And the gap between stress conditions and full-blown crisis is much smaller than most people realize. Now, here's something almost nobody understands about deposit protection, and you need to pay close attention because it could be the difference between losing everything and being completely fine. In the UK, the Financial Services Compensation Scheme protects up to £85,000 per person, per institution. Sounds simple, right? Not quite. First, if you have more than £85,000 in a single bank, anything above that is fully at risk. If the bank fails, you could lose it all. This isn't just theoretical. You might unknowingly exceed this limit with business accounts, savings, and current accounts combined. Second, accounts at multiple brands under the same parent company count as one institution. Think you're diversified with Halifax and Bank of Scotland? Both belong to Lloyds. One limit, not two. Third, the compensation scheme has never been tested on a large scale. It's funded by a levy on banks. But if multiple banks failed at the same time, there are real questions about whether the scheme could cover all claims. Now you might be thinking, surely that won't happen. The government would step in. Maybe, probably, but probably isn't a guarantee. And even if you eventually get your money back, it could take months. Could you go 3 months without access to your savings? Here's the part banks definitely aren't telling you. Remember mortgage stress I mentioned earlier? Many mortgages taken out in 2020 and 2021 were stress tested at around 3%, the regulatory minimum. Banks had to check borrowers could manage payments if rates hit 3%. But rates didn't stop at 3%, they jumped to 5 or 6%. Those stress tests are now irrelevant. Hundreds of thousands of borrowers have mortgages they can't actually afford at current rates. And here's the scary part. Banks know this. They can see exactly which mortgages are at risk, which borrowers are stretched to breaking point. They have the data, they just aren't sharing it publicly. Why? Because if the risks were disclosed, it would cause panic. Markets would react. Depositors would get nervous. Other banks would stop lending. It could become a self-fulfilling crisis. So they stay quiet. They hope rates fall before defaults surge. They hope the economy improves before the wave hits. Hope isn't a strategy, and it's not something you should risk your financial security on. Alright, enough of the scary stuff. You understand the problem. Now here's the playbook for protecting yourself. This isn't panic. It's preparation. Action 1. The immediate check. Tonight, log into every bank account you have. Add up all funds at each institution. Savings, current accounts, ISAs, everything. If the total at any bank exceeds £85,000, move the excess tomorrow. Not next week. Tomorrow. And check ownership. If you have accounts at multiple brands under the same parent company, they count as one institution for protection limits. Action 2. The diversification strategy. Don't keep all your money in one bank. Spread it across multiple institutions. But here's the key. Focus on the largest, most systemically important banks. Why? Not because they can't fail. They absolutely can fail, but big banks are more likely to get government support if they run into trouble. Their collapse would be so catastrophic that the government has no choice but to intervene. It sounds counterintuitive. Why put money in big banks if they're exposed to commercial property risk? Because in a crisis, size matters. Small banks get allowed to fail. Big banks get rescued. Not fair, not ideal, but that's reality. Also consider National Savings and Investments, NSNI. These are directly backed by the Treasury, not the compensation scheme, the actual government. No limit on protection. Perfect for emergency funds you absolutely cannot afford to lose. Action 3. The early warning system. Start monitoring your banks. Sounds tedious, but it's simple. Once a quarter, spend 15 minutes checking. Are provisions for loan losses rising? Are capital ratios falling? Is there negative news about commercial property exposure? Have rating agencies downgraded the bank? Are credit default swap spreads widening? You don't need to be a financial expert. Just watch for red flags. If your bank shows multiple warnings, move your money before problems become acute. By the time a bank failure is obvious, it's too late. Withdrawals freeze. Transfers stop. You're stuck waiting for the compensation scheme. The time to act is when things look bad, but not catastrophic. That window might only be days or weeks. Action 4. Liquidity insurance. Keep some wealth outside the banking system. Not cash under your mattress, but government bonds, gilts held directly or through NSNI, premium bonds backed by the Treasury, or some physical assets that hold value. Keep enough cash at home for 2 weeks of expenses if ATMs stop working. Most people think this is paranoid, until the day ATMs fail and they can't buy food. This isn't tinfoil hat thinking. It's a backup plan. Most money should stay in banks, but not 100%. Action 5. The credit window. Few people think about this until it's too late. When banks tighten credit, they do it fast. Once they do, financing might be impossible at any price. If you need credit, mortgage, business loan, car finance, secure it now, while it's still available and standards are normal. Don't wait until next year thinking you'll sort it out later. Next year, you might not get approved for credit, or if you do, the terms could be punishing. This is especially true for anyone with variable rate debt or loans that need refinancing soon. Lock in fixed rates while you still can. Even if fixed rates seem high now, in 12 months they could look like a bargain. Action 6. The debt reduction priority. If you carry significant unsecured debt, credit cards, personal loans, anything variable rate, work to reduce it aggressively. In a crisis, debt becomes dangerous. Interest rates spike. Income becomes uncertain. Debt you could handle easily today could become unmanageable tomorrow. Focus first on variable rate debt, then high-interest loans, then anything due for refinancing in the next 2 years. Fixed-rate mortgages are less concerning if you can comfortably afford the payments. But for everything else, reduce exposure while you can. Now, the question you really want answered. Is this UK banking crisis inevitable? Honestly, I don't know. Nobody does. Anyone who claims certainty is lying. What I can say is this: the stresses are real, exposures are massive, triggers are plausible, and buffers may not be as strong as regulators claim. But banks are stronger than in 2008. Capital requirements are higher. Liquidity rules are tighter. Supervision is more intense. These improvements matter. Why personal assessment, just one person's view, is maybe a 25 to 35% chance of some banking sector stress over the next 2 to 3 years. Not necessarily full systemic collapse, but something that forces government intervention, mergers, or failures, and causes significant economic disruption. Is that enough to panic? No. Is it enough to prepare? Absolutely. The key is positioning yourself so that if something bad happens, you're protected, and if nothing happens, you haven't done any harm. That's rational preparation. Here's one thing I know for certain: the time to prepare is before it's obvious to everyone. Once the problem is public, it's too late to protect yourself. Right now, most people aren't paying attention. They see headlines about bank profits and assume everything's fine. They don't read the footnotes. They don't understand what a 40% rise in provisions really means. They don't realize what's quietly building. That gives you a window. Use it. Let me tell you one last story. Back in 2007, I knew someone at Northern Rock. Smart guy, solid job. He started getting nervous about what he was seeing in INSEE. He started moving his money to other banks. He told friends and family to do the same. People thought he was crazy. Northern Rock was a respected institution. Sure, there were rumors, but nothing concrete, nothing obvious. 6 months later, Northern Rock collapsed, the first bank run in the UK in over a century. People queued around the block to withdraw deposits. The bank was eventually nationalized. The people who listened to my friend were fine. Their money was diversified. They weren't caught in the chaos. Those who ignored him, some lost money, others had deposits frozen for months during the resolution process. Even if they eventually got their money back, the stress and uncertainty were enormous. I'm not saying we're back in 2007, but the warning signs are there if you know where to look. And the cost of preparation is tiny compared to the cost of being unprepared when something breaks. So here's what happens next. You have 2 choices. Choice 1. Ignore this. Assume everything will be fine. Keep all your money where it is. Don't check deposit limits. Don't diversify. Don't monitor warning signs. Hope the banks and regulators have it under control. Maybe that works out. Probably it works out. Banking crises are rare. But if it doesn't, you'll be one of the people queuing at the branch, staff telling you the system is down, asking you to come back tomorrow. You'll be scrambling to figure out if your deposits are protected while headlines speculate which bank might be next. Choice 2. Take a few hours this week to protect yourself. Check your deposit limits. Diversify across institutions. Set up monitoring. Keep some liquidity outside the banking system. Secure any credit you'll need. Reduce risky debt. It's not difficult. It's not expensive. It's just being prudent. And here's the best part. If nothing bad happens, you haven't harmed yourself. Your money is still in banks. Just spread a little more sensibly. You've got some government bonds for diversification. You've reduced debt, which is always good. You're better positioned no matter what. But if something does happen, you're protected. While everyone else panics, you're fine. Your deposits are within protection limits. You've got liquidity outside the banking system. You're not dependent on credit that might no longer exist. That's rational preparation, low cost if you're wrong, huge benefit if you're right. The UK banking system is under more stress than at any point since 2008. Commercial real estate is a ticking time bomb, with defaults happening right now. Millions of households can't afford mortgages at current rates. Bank capital may not be as strong as it appears. Multiple triggers could turn stress into crisis. You now know more about this than 99% of people. The question is, what will you do with that knowledge? If you want me to keep monitoring the situation and give you early warnings when things change, hit that subscribe button now. The window to prepare closes fast. Once it closes, your options vanish. The stresses are real. The risks are high. The time to act is now, while you still can. Don't be the person wishing they'd prepared. Be the person who acted.